Good morning, everyone, and welcome to our webinar this morning, JobKeeper 2.1 update exclusive for Barristers Clerks. My name is Kim Kellaway and I'm Head of Clients and Markets at HLB Man Judd. Today we'll have three speakers for you. Our first speaker is Basil Scaravilli, who is a manager in our tax consulting and compliance, Bill Nussbaum, director in our tax consulting, and Betty Preshaw, a director in our debt advisory. Now I'd like to hand it over to Basil, and he will commence our presentation this morning. Thank you, Basil.
Great. Many thanks, Kim. Very good morning to everyone. Hope that everyone has been keeping well. So I think when everyone saw the panel of experts just then, I think you all thought, you know, could it be possible? We had the Bill and Basil show that we launched probably about 6 or so years ago. So the Bill and Basil's Barrister Basics, and we now have Betty on board. So we now have the Bill, Basil and Betty show. So I'll give you all a moment to digest that, that unbelievable situation. Anyway, with that out of the way, I thought I'd kick things off with a timeline. So as you know, the original JobKeeper payment scheme was announced on the 30th of March. The purpose of the scheme was to keep people employed, even though the business they work for has suffered a downturn, including a hibernation or close down for a temporary period. The scheme was run from the 30th of March till the 27th of September, and the original scheme enabled eligible employers to claim a fortnightly payment of $1,500 per eligible employee from the 30th of March for a maximum period of 6 months. So then the JobKeeper extension was announced recently and has extended the JobKeeper scheme until the 28th of March. Further refinements were announced by the Treasurer on the 7th of August, mainly as a result of the Victorian Stage 4 restrictions. The extension of the scheme will see now a more targeted and tapered approach with a 2-tier wage subsidy and 2 additional JobKeeper periods of 3 months each. Next. So you can see this is a pretty good infographic, I guess, in terms of what's new in JobKeeper, what we dub as 2.1. So some of the key new features are that there are 2 separate extension periods. The rate of the JobKeeper payment in each extension period is dependent on the number of hours that an eligible employee works or an eligible business participant is considered to be actively engaged in the business. Another feature is that the employee eligibility test date will move from the 1st of March to the 1st of July. So basically staff who were hired after the 1st of March may now be eligible for JobKeeper 2.1. And another new feature is that the declining turnover test will be retested on a quarterly basis in line with the 2 separate extension periods. And obviously the other key aspect is the decline turnover test will be based on actual GST turnover, which Bill will cover soon. Next. So up to the 27th of September, all eligible employees were being paid a flat $1,500 per fortnight rate. So obviously putting aside the issues relating to setting up on your payroll software and paying the top-up amount if the employee wasn't earning that much, it was otherwise pretty straightforward. So now effective from 28th of September, we've got now a 2-tier payment rate applying based on the worker's hours, and the $1,500 per fortnight payment rate has been reduced and will then, as you can see, further reduce on the 4th of January. I'll touch on the 80-hour requirement in my next slide. But from the 28th of September to the 3rd of January, the JobKeeper payment rates is $1,200 per fortnight for all eligible employees and for eligible business participants who are working for more than 80 hours. Otherwise, it's $750 per fortnight for all other eligible employees and business participants working less than 80 hours. from the 4th of January to the 28th of March. It's $1,000 per fortnight if working for more than 80 hours or more. Otherwise, $650 for all other eligible employees and business participants working less than 80 hours. So next. So the big question is obviously, okay, the 80-hour reference period. How do we work that out? So with employees, the 80-hour test can be more straightforward. So an important thing to note when determining the 80-hour test for employees, that you can test across 2 reference periods. If an employee has in fact worked more than 80 hours in a 28-day period, so you can test the 28 days prior to the 1st of March, or you can test the 28 days prior to 1 July. So you have a choice there, whatever one gets you over the line for that employee. In relation to business participants, the individual, there's a criteria now for 2.1 that the business participant needs to be actively engaged in the business carried on by the entity. And there can only be one eligible business participant nominated for each entity. The Commission of Taxation will usually have discretion to set out alternative tests where an employee or business participant's hours were not usual during the 2 reference periods. So there is some discretion there. And guidance has been provided by the ATO where the employee was paid in non-weekly or non-fortnightly pay periods and in other circumstances where the general rules do not cover. So next slide. So with regards to determining whether one is eligible for JobKeeper 2.1, as Bill will discuss later, one needs to demonstrate that they have suffered an actual decline in turnover using the actual GST turnover rather than looking at the projected GST turnover. So the first extension period requires testing the actual turnover for the September 2020 quarter and comparing that to the September 2019 quarter. And then the second extension period, 4th of January to 28th of March, requires testing the actual turnover for the December 2020 quarter compared to the December 2019 quarter. The second table there is indicating that, just making the point there that despite the BAS being due at the end of the month following the end of the quarter, you'll need to determine your eligibility sooner because the monthly declarations are required to be lodged by the 14th of the month. So I guess it's an important thing to just be wary of, that, you may not have, collate your figures to complete your BAS. However, you do need to have a bit of an indication prior to then, because, there is the monthly declaration that's required. So with that in mind, I'll now hand you over to Bill, who will talk about GST turnover and the tests. Thanks, Bill.
Just unmute myself and I'll be right. So next, thanks, Kim. Hi, good morning, everyone. Yeah, it's been a while since we all last saw each other. So I'll just talk about briefly GST turnover, just to understand what goes in. And so it's fairly straightforward for you guys. For other industries, it's a bit more complex, but for you, it's really, it's the GST turnover, but there are certain things which are accepted. So for example, the actual GST that's included gets taken off. And also any sales which are input tax sales, so things like bank interest, sale of shares or things like that, they're excluded from the GST turnover definition. The other one probably down there of importance to you is probably the JobKeeper, any JobKeeper payments that you've got so far, they're not included either in terms of definition of GST turnover. So they're probably the main things. Next. So I thought maybe I'd just touch on, some of the issues that you guys have been facing, and the first one is the reduced sort of turnover levels. And I think some chambers are, I was talking to Angela yesterday. I mean, while some chambers have gone back to normal, there are some chambers which are still suffering and therefore have got reduced floor fees, especially in criminal law and other areas. And of course, this was due mainly to the coronavirus and the impact on the income levels of barristers. So while some barristers have sort of continued to maintain their income levels, many have been claiming JobKeeper 1. Some floors, therefore, may be still entitled to claim JobKeeper 2. In terms of the one question we have been asked a lot is the cash versus accruals basis. Which basis can we use? Under JobKeeper 1, you may recall the ATO allowed entities to use either the cash or accruals basis to calculate GST turnover. However, the good times are over, and under JobKeeper 2, the ATO has advised that you must use the same accounting basis as you are registered for GST. So for example, if chambers are registered under the accruals basis, which probably will be quite a few, you can only compare the quarters using the accruals basis. If you use the cash basis, you can only compare quarters using the cash basis. For barristers who generally would use the cash basis, they can compare relevant quarters under the cash basis. The other interesting article I read, the ATO's tough stance. The ATO, in their usual way, have announced they were taking a hard and fast stance regarding entities sort of satisfying the decline in turnover tests. You may recall under JobKeeper 1, entities could use projected turnover numbers. However, under JobKeeper 2, this is based on actual decline in turnover. So it looks like the ATO, there's going to be no discretion in regard to the actual decline test. The 30% is going to be a hard and fast requirement, as Josh has said. So, as they say, close enough is not good enough. And Angela, I'm sure you'd agree with this saying. So also, after our webinar, JobKeeper 1, earlier in the year, we received quite a few inquiries from clerks regarding reducing floor fees and whether that would have an implication, whether the integrated integrity provisions would apply. Anyway, and I think it's important to, the integrity provisions may apply, and so I think it's important. Sorry, I think it's important, especially if you're going to reassess your eligibility, that you just reconsider these matters. I think generally though, where floor fees have been reduced based on justifiable commercial grounds, i.e. the virus, impact on barristers' income, rental reductions from landlords, the reduction should generally not be viewed as a contrived scheme. And the last one I just wanted to mention was the rent relief, because I know there's been quite a few floors which have been granted rent relief, either to the floor itself or to the barristers themselves. That's been now extended. It's been extended to the 31st of December 2020. Next, please, Kim. So I just thought I'd touch on, well, I'll go through the basic test in a minute, but I thought I'd just touch on the ATO's also released some various alternate tests, especially where an entity doesn't satisfy the basic test. And generally, these are tests can be applied where there's no appropriate comparison period. So, for example, the business commenced, during the year. There's been a business acquisition or disposal. Number 3, there's been a business restructure. There's a business that's had a substantial increase in turnover. Business affected by drought or natural disaster. The business has an irregular turnover, or a sole trader who's had sickness, injury, or leave. Next, Kim. So I thought I'd just go back to the basic test. So as we've sort of discussed, from the 28th of September, businesses seeking to claim the JobKeeper payment, they'll be required to demonstrate that they've had an actual decline in turnover using the actual GST turnover. For many barristers and chambers, this will be really the total sales reported under G1. From September 2020, as we've mentioned, businesses will have to reassess their eligibility, and that's based on actual turnover, comparing the September 2020 quarter compared to the September 19 quarter. From 4th of January, business will need, this is the second extension, business will need to further assess their turnover to be eligible. They will need to demonstrate that they have met the relevant decline in turnover test in the December quarter, and there you'd be going to be comparing December 2020 to December 19 quarter, and that'll run from the period of 4th of January to 28th of March. Now, in terms of the alternate tests, because what we found, some barristers in particular may have failed the basic tests, and so it is worthwhile having a look at. There's 2 particular tests, I think, which may be relevant to both chambers and barristers, more likely barristers. But firstly, is the substantial increase in turnover test. And this is a test where there's been an increase in growth in turnover since September 19. The good thing about this test is that it's a little easier to pass than most of the other alternate tests, on the basis that the first step in the test is you have to have an increase in revenue of only 12.5% over 3 months. So anyway, look, I thought to explain this test a little bit better, I thought I'd give you a simple example. Next, Kim. Okay, so the first alternate test I want to just briefly discuss, I'm just conscious of time as well, is the substantial increase in turnover. And what this test does is, if you can come into this test, it allows you to use a different comparison quarter to September 2020. So you could use the December 19 to February 2020 period and compare that to September 2020. So here's a simple example. So using again the 12.5% increase in turnover, because that seems to be an easier test to pass, I've used, you take the month of November, which was say 50,000, and you compare that to February, which was 60,000, and so therefore, given revenues increased by more than 12.5%, we satisfy the first step. So therefore, the second step requires us to compare the February 2020 quarter against the September 2020 quarter. So the February 2020 quarter, for example, had $180,000 in turnover as compared to the September 2020 quarter. So yeah, if we were comparing September 19 to September 20 under the basic test, sometimes we may not pass, but this allows you to use a different quarter. And in this case, for example, we've had a decline in revenue of 44%. So therefore, we technically pass the test, and therefore we're in JobKeeper. Next. Kim. And there's also another test which we have used for a barrister already called the irregular turnover test. A little bit harder to pass, given you have to have a 50% drop in your revenue, and either in the 12 months before 1st of March or the 12 months before 1st of July. And again, a simple example, so you have a barrister with a September quarter revenue of $80,000. And I've gone back, you can go back to the 12 months of the various quarters. And so if you compare, for example, November 19 to February 20, you can see there's been a decline in turnover there of 62.5%. So technically, you can actually, so it's more than 50%. So there's that you can actually enter into the system for this test. And then next, Kim. And then you work out there's an average quarterly. I won't go through the calculations now, but you work out an average, an average monthly GST turnover. Then you work out the average quarterly GST turnover. And then Kim, next. And then what that allows you to do is you compare this average quarterly turnover to your September 2020 turnover. So in this case, for example, the decline between September and the average quarter is 51,250, which is 39%, which is more than the 30% decline. So the barrister is eligible for JobKeeper. So look, at a high level, just to let you know, even though initially you may think you've failed under the normal basic test, it may be worth having a look at some of these other tests. Okay, next, back to Basil now.
Thanks, thanks, Bill. So with regards to the eligibility conditions for employers, so I just thought it'd be worthwhile running through these again. So basically, the entity is entitled to JobKeeper for an individual for a particular fortnight if they basically meet like 7 conditions. So the first one is that the fortnight is a JobKeeper fortnight. So that's any time between the 30th of March this year until the 28th of March next year, 2021. Condition 2 is if the employer qualifies for JobKeeper for the fortnight. So meeting those criteria, has it carried on business in Australia on the 1st of March? Has it satisfied the decline in turnover test? And then, for fortnights from the 28th of September, if they've actually satisfied the actual decline in turnover for that fortnight. Point 3, if the individual is an eligible employee of the employer for the fortnight, which I'll touch on shortly. Point 4, the employer satisfies the wage condition for the fortnight. So like JobKeeper 1, the employer must pay every eligible employee the minimum amount in each JobKeeper fortnight, and you're considered to satisfy the wage condition in respect of an employee where their gross pay will exceed the relevant JobKeeper rate. Point 5, that the employer notifies the commissioner of their participation. So the enrolment needs to be made by the end of the fortnight. However, as a practical measure, the ATO usually allows until the end of the month. Point 6, the employer notifies the commissioner of required information for the fortnight. So things like details of the entitlement for the fortnight, the details of eligible employees, and selecting the higher or lower rate for the employee. Point 7, that the employer has not notified the commissioner they no longer wish to participate in JobKeeper, and that's an important point which I'll touch on shortly in the sense of nominations. So I'll touch on that shortly. But just that last point about the integrity rule. So I guess this integrity rule was in place for JobKeeper 1 as well, that that an entity that entered into or carried out a scheme for the sole or dominant purpose of obtaining or increasing the amount of JobKeeper can be treated as if they were never entitled. And in addition to that, the entity must be able to demonstrate that it was in business. Next slide. So there's this concept now about a relevant employee. So the first point there is about the nomination. Well, those first two bullet points there is talking about nomination notices. So with the nominations, basically the main rule is if you had an employee previously on JobKeeper, on JobKeeper 1, you don't need to provide them a new nomination. That nomination is basically still in effect up until there is, unless there is a change in circumstances that results in a new nomination notice being provided or withdrawn. So you don't have to actually provide new nomination notices to existing employees that were previously getting JobKeeper. For new employees, though, the employer must have given new employees a notice by a couple of months ago, by the 24th of August. Employees who agree to be nominated must return the notice to their employer. And as I sort of mentioned before, 1st of March, employees of an old employer can actually now re-nominate with their new employer if that's considered the right thing to do. Employees are eligible in the extension period and would be considered to be a relevant employee if they are currently employed by an eligible employer, and that includes if they were stood down or rehired. If they were either a full-time, part-time or fixed-term employee, as at the 1st of July, or if they were a long-term casual employee. And I think the important keywords is about being employed on a regular and systematic basis for at least 12 months as at the 1st of July, and that they're not a permanent employee of any other employer. Next. Bit more straightforward, these conditions here. Employees are also eligible in the extension period if they were aged 18 years or older, as at the 1st of July. If they were 16, 17, they can also qualify. If not, if they're independent or not undertaking full-time study. And that they also met the prescribed residency requirements, or obviously, of course, an Australian resident. Next. So the eligible employee. So again, very similar to JobKeeper 1, just as a refresher, an employee is considered to be an eligible employee if they are a relevant employee of the entity on the 1st of July, as I just mentioned. They're otherwise a 1st of March employee, so someone that you already had previously on JobKeeper 1 for. They're employed by the entity at any time in the fortnight. They're not a permanent employee of any other entity, but casuals are okay. So that's an important note as well. They agree to be nominated by the employer as an eligible employee. They've not nominated to be an eligible employee of any other entity, and that they are not excluded from being an eligible employee. So such as situations where they're receiving paid parental leave or workers' compensation payments at any time during the fortnight. Next, so some of the key points is about, so there's no change to any other JobKeeper rules. I guess some of the key points there is if an entity has previously participated in JobKeeper, they're not required to enrol again, and they're not required to apply the original decline turnover test again, but they are required, as Bill mentioned, to satisfy that additional actual decline in turnover test from the 28th of September. I guess I just wanted to touch on just that last bullet point about the service entity arrangements and how that impacts on JobKeeper 2.1. As I know, some of your entities, some of your chambers are structured in this way, and we did get a fair few queries from our last webinar. So the main issue in relation to service entity arrangements was that while the decline turnover may be readily apparent for the trading entity, it does not have any employees and is therefore obviously unlikely to qualify for JobKeeper. The service entity, on the other hand, although having the employees and meeting most of the criteria, it may not have met the decline in turnover test, as the arrangements between it and the trading entity may result in very little impact on the service entity's turnover. So the government had provided an alternate decline in turnover test for the eligibility of these service entities that provide employee labour to group members and that have not met the basic test for decline in turnover. So this alternate test was where an entity provides the services of its employees to one or more related entities, where those related entities carry on a business deriving revenue from unrelated third parties. So the alternate test basically be by reference to the combined GST turnovers of the related entities using the services of the employer entity. So these special rules only apply where there is a group structure which is defined as a consolidated or a consolidatable group or a GST group as well. Obviously, the integrity rule is still there where the service entity reduces the fees it charges in situations where the service entity reduces the fees it charges to the business entity for a sole or dominant purpose of accessing the JobKeeper scheme. However, the ATO has indicated recently that it will look favourably on some of these arrangements where the changes were a result of an economic downturn due to COVID-19. So obviously we are able to assist you in determining whether your particular service entity arrangements will qualify for JobKeeper 2.1. So with that in mind, I'll now hand you over to Betty, who will provide an update on Barrister Finance. Thanks, Betty.
Thanks, Basil. Thanks also to Bill and Basil for welcoming me to the Bill Basil Barrister Basics. I'm honoured to be a part of it. So today I'm going to be talking about barristers' debt finance, specifically for barristers. So there are two main components to borrowing money in any situation, and that is servicing your debt or your affordability, and then also the security for that specific debt or for those for that loan. So financials are obviously a key component to the servicing component of debt or affording your debt. So the banks look for 2 years financials, 2019 and 2018, if we were looking at a specific application today. 2020 financials are required in about March next year, and year to date as well. COVID has obviously impacted the way banks look at financials as well, and the banks do look at the particular borrowers' ways that they've looked at impacts on COVID and how they've worked around debtors and expenses and any sales drops that they might have had. So 30, 60, 90-day debtor listings are important to show how barristers or their team have managed the cash flow planning on the debts. So a work in progress schedule is also important. And ATO debts, when it comes to borrowing money, the banks don't like to see any ATO debts or any ATO payment plans as well. Now, when it comes to security, the banks obviously like some sort of property security. So residential property is a great one. There are banks out there that will actually do 90% lends on residential property specifically for barristers. So if you're familiar with borrowing money, the banks do like to see a 20% equity when it comes to borrowing money, and anything greater than the 20% or anything less than the 20% rather, often the borrower needs to pay a lender's mortgage insurance. So for any new barristers to the market that have got don't have as much equity as a barrister that's been in the industry for a long time, their equity might be not as strong as a barrister that's been around for a long time, but their income capacity is quite large. So in those instances, it's, you know, there are banks out there that will actually lend to those barristers up to 90% of the value of the property. Not all banks, so you are limited to the banks that will do that. Commercial property is another security that banks look at, and usually they look up around 65%. In some instances, they will even look up to 70%, but yeah, usually it's around 65% at least against the commercial value of the property. Now, specifically for barristers, there is barrister chamber finance as well. And so if you're looking at purchase, if a barrister is looking to draw some equity against their barristers' chambers, the banks look at up to 50% of the value of the chambers. So in a lot of instances, barristers specifically might be business relationship managed, or they might be private bank relationship managed. And so what the banks do in the instance of a barrister's chambers, security property and any residential property that they might have, they do cross the securities. So even if the barrister's chambers is, say, worth $300,000 and they're only able to draw $150,000 from the barrister's chambers specifically, they can use residential property as well to draw down for business or investment purposes. Next. So I've just wanted to just quickly go through a case study that we've recently worked on. And in this instance, there was no commercial deed. It was just purely residential and investment properties, because a lot of professionals and barristers have investment properties. So this specific client had been with their existing bank for in excess of 20 years and sort of came to me and said, "Oh, Betty, I think I'm paying too much. I know I'm paying too much. Can you just have a quick review of my loans and tell me what the market's doing?" So when we looked at this specific client's debt, they were paying a lot, and she actually, it was a she wasn't actually comfortable with approaching her business banker directly. So she was quite comfortable in getting me involved in those conversations. So the three of us sat down, the bank, myself, and the client, and we went through and we actually restructured her existing debt with her existing bank, because she didn't want to take her banking elsewhere, because, you know, she'd been with this bank for a long time and she was quite comfortable with them. And together with the relationship manager, we worked together and we structured this particular client and her investments. We fixed the investment home loans. The interest only we paid in advance for 12 months, and we were able to save her $60,000 over a 2-year period, which was quite a saving for her specifically. I mean, you know, it paid for her her receptionist. So yeah, it was a real win, because interest rates at the moment are really low. You probably already know this, but they're in the low 2s. So, you know, if you've got debt, if you've got debt of over 3%, you are paying too much. And yeah, there's so much variance across all the banks. So it's worthwhile having a look around and seeing what's going on out there, because the interest savings that clients are making are incredible. Next. So I guess from our perspective, James and I, how we can help. James and I aren't new to the industry. We've been in the industry for a long time. So we haven't just donned our hats and called ourselves specialists. We've probably worked in the industry for over 25 years, and that's each of us, so a long time. We've got access to actually over 25 different lenders, and some of the major banks, all the major banks, and all of the, you know, banks that you may not have heard of. We've actually got no alliance to any bank. We've got great relationships with all the banks. Our alliance is actually with all of our clients, and we often jointly relationship manage our clients with their business banker, with their relationship manager, and because that's what we were doing in our past lives. We were both relationship managers in the corporate and business banking and private banking space as well. So we work together with them. We've got some great contacts out there as well that we love working with. So we essentially provide structuring solutions for debt. We do interest rate health checks, and these are all complimentary. So yeah, feel free to reach out, or if you've got any questions, please let us know. Thank you.
Okay, so we've now come to question time. And it doesn't look as though we have any questions in the Q&A Zoom control. So that either means that Bill and Basil, that you've answered everyone's questions. Ange, did you? There you go. It looks as though we have answered most people's questions, which is fantastic. So I might just go to our end slide here. I've got another question. Great, thank you. Okay. So if you've got any further questions, we will be providing you with these slides plus the recording. So if you would like someone from HLB, Man Judd, to contact you, whether it's on JobKeeper 2.1 or the alternate decline in turnover testing, Barrister Finance, debt advisory, or other matters, please just use that polling. Betty, just in terms of the discussion that you and I had, I think it would be wonderful to be able to also offer your services to the Barristers Clerks themselves.
Oh yes, absolutely.
So did you want to just quickly discuss how you would do that? Because I know that we've just finished a flyer on that. So I'll just hand it over to you just quickly.
Oh, thanks, Kim. Yeah, thanks very much. I guess how we could help is that we could just do it. Yeah, when we talk about debt, we talk about commercial loans, business loans, but we talk about residential home loans as well. And so we've got access to all the lenders, and we've got a great search engine that sort of assists us in going out there and comparing your existing loan with what the market's doing. Refinancing, if that's the case, it does not cost a lot. I know a lot of people think that, oh my goodness, I don't want to really refinance. It costs a lot of money. It actually doesn't. It costs around $700, and that's the registration of the incoming mortgage and the discharge of mortgage from the outgoing bank. It is costly if your loan is fixed. Fixed rate loans are contracts with banks that you cannot break. But usually we don't even look at refinancing. Usually we go to the existing bank and we sort of say, okay, well, you're currently paying this much. What can you do? The fact that we're involved, the banks, because we provide a nice product summary with 4 or 5 different options, and you're able to take that to your existing bank and say to the bank, well, look what I can get, out in the market. Why am I paying 3.5%? And I can guarantee your existing bank will drop their interest rate, and you'll probably end up saving just by presenting them with our product summary. But if you want to take advantage of the lowest rate, it's probably not going to be with your existing bank, because the banks usually offer these fantastic rates for new customers. But look, I'm happy to have a chat to anyone that wants to have a chat about their existing home loan, and they just want to say, just want to see if they are paying too much. I'm happy to have that discussion. And there's so many great structuring solutions if you're looking to accumulate wealth in the property market. We're backed by this great chartered accounting firm as well, so we have all this tax expertise behind us in how to best negatively gear your properties as well. So we really can absolutely. It's not just barristers. We can help all your clerks out there as well, and happy to have a chat free of charge, complimentary chat. Thanks, Kim.
That's all right. That's perfect. Because I must say, I've actually personally just done this, and I was very surprised because my bank would not give me a better rate, and that was because I was an existing client. Yet you go to a new bank, and not only have I ended up with a mortgage rate of 2.1%, but I got $6,000 cash back.
Yes, so that's right. That's exactly right. So they're offering these great cashbacks as well. Some of the banks are offering these fantastic cashbacks, but their turnaround times are just so inundated with applications that so I mean, that's another factor as well. We can sort of tell you how long it will take as well, because there's some banks that have got these fantastic, you know, service engine and the processing times are really quick. So often when I have clients that ring me and say, Betty, I've just found a property on Saturday, I've bought it, I need money, you know, we can sort of choose the best rate, but also the fastest turnaround times. But then if you want to take advantage of cashbacks and everything else, then, you know, we've got access to that information as well. Yeah, absolutely.
Okay, thank you, Betty. So I'd like to thank Bill, Basil and Betty for today. 10 minutes to spare, which is pretty good. I certainly don't like to go over time. So as I said, we will be sharing the slides, so our presenters' details are there, and please don't hesitate to contact us. So I'd like to thank you all for attending today, and look forward to seeing some of you hopefully before Christmas. Take care and stay safe. Bye-bye.